Welcome to the Taxation and Tech panel here at Inframarginalism and Internet. We've got a wonderful group of panelists here for you. And Daniel Crane, professor at the University of Michigan Law School, will be moderating the panel. So I'm going to turn it over to Dan now.
Well, thanks very much, Ramsey, and good morning to everyone. It's a pleasure to be in this virtual session, and thanks to Ramsey and the University of Kentucky for organizing this fantastic conference and for inviting us to participate in this morning's session. So the title of this session is Taxation and Tech, and in fact, 3 of our papers are about taxation and tech, and 2 not directly about taxation, but raise questions that we think are going to be synergistic with and allow for really interesting discussion. John Newman's paper is about attention, and Joe Manning's paper is about the importance of the Nile as a corridor of information access and power in ancient Egypt. And so we're going to go through these 5 papers initially, and I will just briefly introduce our 5 speakers and then turn it over to them for a short presentation of their papers. And then we'll have an opportunity to sort of talk thematically about what these papers raise as we think about this important issue of the digital world and power and the way in which the benefits really of the digital age that we are in are shared and spread, which is, after all, the theme of this conference. So let me begin by just listing our speakers, introducing them briefly. So first of all, my colleague Ruben Avillona from the University of Michigan will present on a new corporate tax model. Zach Liskow of Yale Law School will present on the psychology of taxing capital income. John Newman from the University of Miami Law School will present on regulating attention markets. Manoj Viswanathan from Hastings Law will present, and I can see Manoj now, excellent, glad you were able to get on well, will present on implementing a modern progressive consumption tax. And then Joe Manning, Yale Classics and Yale Law, will present about the importance of the Nile, and we'll think about the implications of that historical learning for the topics we're thinking about today. So without further ado, let me turn it over to Ruben for the first presentation.
Thank you very much, and thanks, Ramsey, and everybody who organized this conference. It's really a wonderful conference. I've been attending since yesterday, and I've learned a tremendous amount, so I really appreciate it. Let me see if I can share my screen here. Okay. Yes, okay. You see? Then?
Looks good, Ruben.
Looks good? Okay. All right. Do it again. Okay, so this is about the new corporate tax. And basically, the question that I posed at the beginning of the paper is, why do we tax corporations? Taxing corporations is a little strange because corporations are not people, despite what Mitt Romney said, and they are legal entities, and the imposition of a tax on legal entities is something strange because the tax really has to be imposed on people eventually, and there's some uncertainty about which people the corporate tax falls on. And the traditional answer to why we tax corporations is that this is an indirect tax on the shareholders, because if we didn't tax corporations, then given that corporations are separate entities from shareholders, rich shareholders in particular could put their income inside corporations and not pay tax on them on the income until they distribute a dividend or until they sell the shares, and that is inappropriate, so we have to tax the corporations. But there are problems with these explanations. And I think that it's not a valid reason to have a corporate tax, which is a very complicated tax, B, a tax that has significant deadback loss and transaction costs and so on. So I don't think that's a good enough reason for 3 reasons. One is, after 50 years of debate among economists, we don't know what the incidence of the corporate tax is. Some say it's on shareholders, some say it's on capital providers, some say it's on labor, some say it's on consumers. It probably varies depending on the response of various groups to the tax, but we just don't know what the incidence of the tax, and the implication is we don't know that it actually falls on shareholders. Second of all, there are ways in which shareholders can be taxed directly. In the case of non-publicly traded corporations, it should be relatively easy. You just attribute the income to the shareholders, like we do with partnerships and S corporations, and just tax them. In the case of publicly traded corporations, that's harder because the shares trade all the time, but the solution is something that I think Zach Liskow is going to talk about later, to simply tax the shareholders on the change in the value of their corporate shares, because by definition, there's no liquidity issue and there's no valuation issue either. We know what the value is because it's publicly traded. Finally, in the US, at least 70% of shareholders are tax exempt. That is pension funds, taxes, education institutions, and so on and so forth. And if we believe in the reason that we exempt these shareholders from tax, then we shouldn't be taxing them directly through taxing the corporations. So I don't think that that's a good reason to tax corporations. And so if that was the only reason, we might as well get rid of the corporate tax. But I think there's another reason, and that is in fact the original reason that we adopted the corporate tax back in 1909, before we had an individual income tax. In fact, when we adopted the corporate tax in 1909, taxing individual shareholders would have been unconstitutional under the Supreme Court decisions at the time. And that is to limit the power of large monopolistic corporations and regulate their activities. So you have to remember 1909 was at the height of the first wave of antitrust enforcement. This was just when the Taft administration was litigating against Standard Oil and American Tobacco, the cases that eventually made their way to the Supreme Court and led to the breakup of Standard Oil. So this was the major public policy issue at the time. And here is President Taft in his message to Congress. Quote, "If now by a perfectly legitimate and effective system of taxation, we are incidentally able to possess the government and the stockholders and the public of the knowledge of the real business transactions and the gains and profits of every corporation in the country, we have made a long step towards the supervisory control of corporations which may prevent a further abuse of power," end quote. So this was essentially what this was all about. The entire legislative history, the debate in the Senate was about that, and the opposition to the corporate tax was more in the name of why do we need to tax all corporations if what we are targeting is the large corporations, the trusts, and we should focus the tax only on those. So everybody agreed that the purpose of the tax was a regulatory purpose to address, corporate monopolization. But my point is that if that is the reason that we are taxing corporations, then we should have a different structure of the corporate tax. And the current corporate tax is a flat tax. It's 21% across the board. Until 2017, we had some progressivity in the tax, but very small corporations. This was a remnant from the 1930s, and this was abolished in 2017. Instead, I think that we should have a progressive structure for the corporate tax. And it should be set at zero for normal returns, because normal returns, the marginal returns, to talk in the language of this conference, are not monopolistic. They don't pose a particular problem. They're subject to market competition, and there's no particular reason to tax them. But we should have a sharply progressive rate for inframarginal returns for rents, because basically taxing them is efficient. All the economists would generally agree, because it doesn't affect behavior. And at the top, I think I would suggest a very high rate. So above $10 billion in annual profit, the tax rate could be as high as 80%, which was the World War II excess profit tax rate, the top rate that we ever had for corporate profits. So if you look, all the big taxes had over $10 billion in profits in 2019, and probably more in 2020, because they all benefit from the pandemic. If you think about, let's say, Amazon or Google, I mean, we spend endless time in front of our screens, right? And there are other corporations that had that level of profits, but they all are more or less monopolistic or quasi-monopolistic. They're listed in the paper if you want to take a look. So that's the basic proposal, and it's not entirely new. As I said, the idea of progressive corporate taxation was invented in the 1930s under the New Deal, but we've kind of let it go dead, and I'm proposing to revive it. Now, what would be the effect of such a tax? Well, there are various possibilities. One is it could incentivize them to break up. But that is, in fact, what some of the antitrust scholars suggest we should be doing. That is, one of the things that characterizes big tech in particular is that they've been acquiring their potential rivals. And maybe if we tax them at a progressive rate, we should expect them to divest of some of those. And alternatively, if they don't break up and if we manage to tax them at very high rates, then that means that we are taking some of the rents and transferring into the public fisc, and we can use that for various investment that the country really needs, like infrastructure, education, or various other, for which we are now currently borrowing, but there's no particular reason that we have to do that. Alternatively, and this is something that I learned from the Benzel and colleagues presentation yesterday, the big tech used to be much less profitable when they really focus on expanding their user base as opposed to focusing on advertising, and maybe that will incentivize them again to focus less on advertising and expanding the user base more, and that is a good thing generally because it improves welfare. So that's basically what I think might happen. And then finally, there are some points in the paper that I just want to mention briefly because I always get questions about them. That is, can't such a high tax be avoided easily by various ways? So I'll just mention briefly and we can discuss this more. First of all, we have to tax global income, that is the entire worldwide income of the corporation. We do not want to allow a deduction for options, which is the main form of employee compensation, when they are exercised, but rather when they're granted, because we know the value granted, we can value options, and it's much smaller. We should match R&D deductions to when the income is that they generate, which is the rents, is earned, rather than allow them to be expensed upfront. We should not allow interest deductions, and we should prevent inversions. That is, we should prevent these companies from migrating overseas, which in this case is relatively easy to do even under current law, because all of the founders of these corporations have billions of dollars in unrealized income, and if they do an inversion, they will be taxed on that, and I think that will be something that they would not be happy to do. So that's what I have to say, and thank you very much.
Great, thanks very much, Ruben. That was certainly interesting and provocative start to our discussion, so I look forward to discussing that further. Zach, the floor is yours.
All right, you guys can see me? I'll take that as a yes. All right, so thanks so much for the invitation to talk about the psychology of taxing capital income. This is joint work with the terrific Edward Fox at the University of Michigan. So the internet and many other things have produced huge wealth, and part of what this session is about is how to tax it. Reuven gave one way, and I want to talk about another way that many of us think, that many people think we ought to be taxing this wealth. So keep this question in mind, how can we tax capital income? So let me begin with an example. In 2015, Mark Zuckerberg's Facebook stock went up by $11 billion. He sold no shares, and he paid almost no tax. So I don't know about all of you, but in 2015, when I got richer by earning my wages, I paid taxes. Zuck did not. How is this? This is because of the realization rule in income tax law, which requires that assets must be sold or otherwise disposed of for a tax to be imposed. And this is the case in almost all cases all around the world. This is a ubiquitous thing. This realization rule creates some big problems. First, it is inequitable. Estimates suggest that the realization rule means that about $2 trillion per decade goes uncollected. This is overwhelmingly among the rich, since they're the ones who have the assets. It's inefficient, since it creates incentives to not sell assets or to invest in certain assets. And it's complicated. Tax lawyers and scholars will tell you that there's a huge, complicated array of laws that are designed to address taxpayer gaming, since taxpayers are going to want to realize losses and avoid realizing gains. So all these reasons are part of why the Senate Finance Committee chair has a, I think, long shot plan to help address it. All this raises the question, though, why do we tax capital this way if it's so bad? Or why do we tax capital this way at the individual level if it's so bad? So for harder to value assets, it's easier to explain. If we had like a piece of art, it'd be kind of hard to know how much it changes in value each year and to tax on the basis of it. But for easy to value liquid assets, like publicly traded stocks and bonds, the realization rule is really something of a puzzle. So this paper uses a survey experiment to understand the psychology of the realization rule and gain insight into this really crucial aspect of taxing capital income. So what do? So we ask people. So we recruit a nationally representative sample of 5,000 respondents in the US. We give them some orientation, and then we give them a hypothetical. You have a person, her stocks go up in value, she does not sell. Should those be sold today when they go up in value or in the future? And I'm showing you the results here. People overwhelmingly, 3-to-1, prefer taxing only at sale and not before sale when the stocks actually go up in value. So we think that this huge disparity in public attitudes probably helps explain the policy that we see. Now, we also kind of push people. We try to persuade them, give them information, and see if their attitudes change. We can succeed in doing that. If we have a video of me actually saying, taxing gains today when they go up in value is a really good idea, we can actually double the preference from 25 to 49%. Still a minority, but pretty big change for a 1.5-minute long video. We can also decrease by doing the reverse, saying this is a really bad idea. It's really harmful to a whole bunch of things. It's complicated. We can reduce support by 1/3. But when we combine a pro-tax video and an anti-tax video, turns out support for taxing today doesn't really change much at all versus the control, 29% versus 25%. So what this suggests to us is that this is the best evidence we've got of what people would think if they could engage with it, if there were a public debate. And ultimately, if that there would not be much support for taxing something like, for taxing across the board, the kinds of gains that have allowed Zuck to get rich without paying tax. There's a flip side though, which is that there's quite a lot of support for taxing at sale. So people like taxing stocks at sale and small businesses at sale, even homes at sale. And interestingly, and quite surprisingly to us, there's quite a lot of support for taxing bequeathed stock. So currently, when you die with appreciated assets, you do not pay tax on those gains. And it turns out that when you ask people, 67% think, no, you actually should pay tax. These things are not trivial. So both the bequeathed stock, which is not taxed, and also homes, which the appreciation of which is typically, much of which is not taxed. These are exclusions that cost $1.2 trillion over the next 10 years. These results suggest ways that we can raise quite a lot of revenue in ways consonant with the public's intuitions and psychology about realization. All right, so we try to delve deeper, try to understand what's underlying the views that people have, try to understand the deeper psychology, and we test a whole bunch of different things. But two reasons stand out as explaining a lot of the results that we see. First is that, although this is an income tax, people seem to a significant extent actually want to tax consumption and not income. This is because our data suggests that a significant fraction of people believe that when gains should be taxed depends upon when they are consumed, not when the gains are actually earned, or even when they're sold. In particular, about 30% of opponents of taxing gains before sale are willing to tax unsold stock gains if the person borrows against the gains to fund consumption. So in short, what this we think this means is that for a significant share of these opponents, for about 1/3 of them, really what they're trying to get out of the income tax is not taxing income, but rather taxing consumption. All right, so that's reason one. Reason two is on mental accounting. So this is the idea that people have separate accounts in their heads of different ways of getting richer. So there's wages on the one hand and unsold stocks on the other. And there's robust empirical evidence that people are much, much likelier to spend out of wages than out of unsold stock gains. And what we're testing for here is if maybe the same phenomenon explains people's preferences regarding taxation. So we ask people to imagine that they're tithing. They have to give 10% of their income each year. And then we ask, would you include or exclude unsold stock gains when you're choosing whether to tithe or not? So 75% of people, as you can see here, choose to ignore unsold stock gains when they're tithing. But then we have this really, really big disparity between those who want to tax only at sale and those who want to tax before sale. In particular, those who want to tax only at sale are way, way, way likelier to ignore the unsold stock gains. So this to us looks like the same things that are driving people's conceptions of income with respect to tithing for mental accounting purposes also might be driving their intuitions, their psychology regarding taxation. So to conclude, what we show here is that the public seems to strongly resist taxation of gains before sale, and it seems to relate to deep psychological tendencies. This is really important since we, or many of us, want to tax these gains from inframarginal internet gains or otherwise, but there's this hindrance. And this likely helps explain the persistence of the realization rule here and everywhere in the world, and it'll probably create a significant psychological barrier to taxing capital income that does not apply to labor income. Labor income is realized every year. Capital income tends not to be. So what can we do? When you think about policy, typically one thing you want to ask is there another alternative out there that might be better and that is politically feasible? And we're suggesting here that this alternative of taxing individuals that many people think is a good idea might not be. So as a result, we should look to second best options, or at least we can develop second best grounds for those options. Or this could just be doing what's democratically legitimate. So let me list 4 of those. One is taxing appreciated assets at death. It's something that the Biden team is definitely thinking about. These results suggest are pro doing that. Second is taxing housing gains at sale. I showed you the results. People like doing that. Third is raising the corporate tax rate. This is very much in line with Reuven's argument. This is a different justification for it, but nevertheless, I think a very potent one. Even among all these people who don't want to tax, even Zuckerberg on his stock gains still want to raise the corporate tax. And then finally, this is a reason to raise the capital gains tax rate, which in the results I didn't show you, people are also quite favorably inclined toward. So these are several ways that I think our results suggest are good ways, feasible ways to tax capital. And I look forward to the discussion.
Thanks very much, Zach. That was very interesting and very complementary with Reuven's paper. And now I think John is going to take us into a little bit of a different direction and talk about attention.
All right, thank you, Dan, and thank you, Ramsey, and the University of Kentucky College of Law for the invitation. I can honestly say that I never thought I would be speaking on a tax-focused panel, so this is a new experience. New experiences are always good, so thank you for including me. This paper is a very broad paper. There's a lot going on there, probably a little too much going on, in fact, but a little part of it is about tax. I'm going to focus on that, but give you the setup first. The overall thrust of the paper is to take attention seriously. And instead of focusing on the information and privacy aspect of a zero price market like a Google or a Facebook, to really focus on attention and treat it as businesses treat it, which is as a commodity, right? It's now bought and sold. Now, I start out in the paper by dispensing with the usual way of conceptualizing these markets, which is as two-sided platform markets. That gets you into a very messy place very quickly, especially in my area of expertise, which is antitrust. And instead posit that we can think of these as pretty traditional commodity production type markets with a 3-level top-down distribution system. You've got the producers at the top, that's us, people. You've got distributors in the middle, that's companies like Google, running search or Facebook social network. They distribute our attention to the consumers. Advertisers are the consumers. Very simple. We in the antitrust world are very familiar with thinking of industries as being organized this way. So that's kind of the starting point. Now, I next turn to the I think fairly well accepted proposition that attention is a scarce asset, right? Our attention can be overloaded. One, it can be depleted. Two, this is scarce in a couple of different ways. It's also tradable, right? It is the subject of transactions in the real world, this top-down distribution system I've laid out. And so proceeding from that, we can see that not only is attention scarce, but certain problems are attendant to the fact that attention is scarce, and we have now firms competing for it more than ever. In particular, when our attention gets overloaded or when it gets depleted, right? You kind of think of a car either running out of gas or overheating. Research shows, a variety of experimental research and some field research shows that people can, unsurprisingly, engage in suboptimal decision making. I spend more on a car than I otherwise would, for instance. Two, we exhibit pronounced biases, both racial and gender. We can all, I think, intuitively feel that this may be right. When you think about yourself at the end of a day when you've expended a lot of attention on a variety of things, you're probably not your best self. Right? It would be kind of a shorthand way of thinking about this. What this then can lead to is a kind of negative externality problem, right? Neither the distributor, Facebook, Google, et cetera, nor the consumer, the advertiser, nor even the producer, me, will internalize all these negative effects. If I, after engaging in a bunch of attention depleting activity, go out into the world and behave in a negative manner vis-a-vis third parties, this is a classic negative externality. And what that suggests then is we may have an excess of attention consumption, again, by the advertisers out there. So you can respond to that in a couple of different ways. You could do a sort of a price cap or a cap on the amount of attention that can be consumed by advertisers. Josh Hawley's proposal to ban infinite scrolling and other addictive features would be a kind of way of doing this. Alternatively, though, you could do a Pigouvian tax, which is a classic response to a negative externality, of course. We could tax sales of attention just like we tax sales of other things, right? This would be a kind of sales tax that could be imposed on the Facebooks, on the distributors of the world, right? Or it could be levied directly on the consumers, the advertisers. Now, right now, our tax policy does essentially the opposite of a Pigouvian tax. We don't discourage or disincentivize attention consumption at all. We actually strongly incentivize it. So we're starting from a point of doing the exact opposite of what we should be doing if we buy the negative externality story. Now, I want to pause for just a second and distinguish what I'm talking about from a couple of different tax on digital platform type arguments. First, this is not like a tax that's designed to just stop people from being on Facebook. Right? So people have proposed that, saying that that's like not productive time and we should discourage it. This is not that. I'm saying there's a consumption problem here, an overconsumption problem. And that's really a focus on the advertisers, not on us, the producers. It's also not exactly like a tax to incentivize more like privacy protective practices by digital platforms. That Paul Romer has proposed that, I think, in the New York Times. This is not that either, right? I'm focusing on attention, not privacy, not information. And it's not even like Reuven's kind of anti-monopoly tax, right? Again, this is a Pigouvian proposal, although I am very sympathetic to Reuven's project. This is a little different, I think. So how could you exactly put some contours around this Pigouvian tax on attention consumption by advertisers? You could start off by just eliminating the current favorable treatment by removing the deductibility of advertising expenditures, or even lowering it from the current 100% to something less. Reuven helpfully suggests that might be simply done administratively by the IRS itself, potentially. I'll leave that to the tax experts. Could be done by Congress, could be done by states. I think Maryland maybe recently imposed something like this. So there are a variety of ways institutionally to do this. That said, I think this, like any of the proposals in the paper, would be a kind of an incomplete response. I think it could potentially get at some of the overproduction and overconsumption problems. I don't think it on its own solves a market concentration problem, right? It doesn't necessarily solve a rent problem. And so I would view it very much as complementary to a proposal like Reuben's rather than a substitute. So that's the general idea. And of course, there's some other stuff going on in the paper too. But with that, I'll turn it back over. I'd love to hear everyone's thoughts.
Well, thanks, John. As a co-antitrust person, I'm very proud of you for having said the words Pigouvian tax on this panel. So I feel like we've been a credit to our profession amidst these people who think much smarter thoughts than we do sometimes about tax. So thanks for that really interesting presentation. So swinging now back to directly a discussion of tax topics. Manoj, who's going to talk about implementing a modern progressive consumption tax. Manoj, floor is yours.
And thanks, and everyone else at Kentucky for organizing the conference, inviting me. And so my draft piece talks about a different way of progressively taxing consumption. And so progressively taxing consumption is something that has been about at length. And so the paper starts off with a normative assumption that consumption is a proper base to progressively tax. And once that's established and taken as a given, I think that this individual accounting method of progressively taxing consumption offers several advantages to the previous approaches that other scholars have discussed. And so just a brief rundown of what's been discussed previously. I'll first put forth this idea of, well, look, you can tax consumption by proxy, by just taking it to be savings. So that approach to taxing consumption still requires identifying income, identifying savings, still filing tax returns. So there's still an administrative burden that is inherent in a cash flow approach to progressively taxing consumption. Other approaches have done something similar to a flat tax plus a demograph. In other words, if you just want a VAT in the US and then rebate people who you think are at the lower end of the distribution, you can achieve progressivity almost indirectly. Now, the problem with that is if you think that consumption is, as a normative matter, based to tax, you're going to lose out on some high-end progressivity. You'll certainly get some benefits for the lower income folks, but you're going to end up treating people with very, very high levels of consumption approximately similarly. Another approach has been the wage tax exemption. So in certain stylized assumptions, which Reuben actually alludes to in his piece, you can have an equivalence between an exemption on labor income and a consumption tax. And the problem is to fall apart if you've got progressive rates or if you've got the treatment of supernormal returns. And so some of the specific benefits that would be associated with a consumption tax levied on individual accounting or on is that it's going to trade defining or having to define income and savings for defining consumption, which I argue is a little bit easier. And so you also can out of needing to file returns because you're not going to need to have at the end of the taxpayers having to, similar to what's being done currently with income tax, file anything with the IRS. The collection, the remittance would happen in the background with every transaction. And so to the extent that the goal is to transition fully away from the federal income tax, it would be an easier approach. This is, and I thank Reuben for giving me these terms. If we want to adopt an in lieu of progressive consumption tax, it would be an easier end result. because you wouldn't have as many filing requirements. But even if you don't want to have if you want to have just in addition to the existing federal income tax, it would be easier to have both of those working, as the administrative requirements for an individual accounting progressive consumption tax would just be simpler. Now, at least for purposes of this paper, agnostic as to whether or not the progressive consumption tax, this one or any of them, would be an lieu of tax or an addition to tax. But I think that the individual accounting version would work with either. And so some details of what I actually mean of how to implement this individual accounting progressive consumption tax. The IRS can maintain a database of aggregate taxpayer consumption. And so over time, more and more consumers are using non-cash methods to consume. And so the infrastructure for a lot of US consumption, tracking US consumption, is already there. For electronic payments, credit cards and debit cards, it's relatively straightforward to impose reporting requirements on credit card processors and or banks, whatever the correct entity would be, to report the consumption amounts. And so obviously we have an issue with cash transactions, especially if we're going to be taxing at potentially fairly high rates, consumption done electronically. And so with cash, it's a little bit harder, but certainly not insurmountable. You can think of a system in place where you've got self-identifying done via code on someone's smartphone in order to obtain the taxpayer's true marginal consumption tax rate. And the incentive would be there for taxpayers to do this because the posted prices for a good at a store, say, would be the highest marginal tax rate. And by self-identifying for a cash transaction, the consumer would obtain their actual true, probably lower rate, and there would be this incentive for taxpayers to self-identify. And so the big objection would be, well, what about privacy concerns? And so tracking taxpayer on a per transaction basis at first blush seems pretty invasive. But I would that this is actually less than what private companies are already receiving about everybody's consumption habits. Credit card companies know what you're spending, where you're spending. The stores actually know specifically what you're getting. Rewards programs we're all almost by default enrolled in. When we put our phone number at the grocery store, they already know what we're buying. And so this information is already being not just collected, but shared amongst private companies. So on the IRS side, you might say, well, look, fine, you're getting this information, but I don't feel comfortable with the government having this information. Again, I would argue that this is comparable to the data that the IRS already receives from taxpayers. The IRS already knows your family status, your employer, your kids, the investments you purchase, what you pay for them. And so I don't think that privacy concerns, although there are some things that would need to be addressed, as they might appear. As a backstop to the privacy concerns, in some ways, cash would be the ultimate opt-out. So to the extent that one is extremely concerned about their privacy, able to pay in cash just at the highest tax rate. And so there would be this option to safeguard one's privacy via cash transaction, if so. And so there are lots of design questions about this tax that are still open, but they're answerable. And these design questions aren't specific just to an individual accounting progressive consumption tax. They're just to consumption taxes in general. And some of these are, what do you do about filing statuses? How do you deal with joint filers? What about durable consumer goods, artwork, real estate, jewelry, donative transfers, like gifts, inheritances, and taxation of business entities. And again, these are questions that would need to be answered, but they would need to be answered with any consumption tax regime. And so lastly, and this I recognize could be both a feature, but potentially a bug of a tax system quite tweakable, but an individual accounting progressive consumption tax tweakabilities relative to consumption considered, because there's a bit more ease with providing exemptions, not just at the consumer level, but also at the goods level. By and large, sales taxes and VATs have only been good at one or the other. And so there's one potential advantage to taxing on a individual accounting basis. There's also this ability some tax policy immediately, because the tax collection and remittance would happen in real time. You've also got this ability to immediately reduce rates in areas that have been struck by natural disasters. You've got around filing periods in a way that other tax systems haven't really allowed. Again, there's some other details that would need to be worked out. So folks that are currently relying on cash transactions, undocumented folks, people that are paid under the table, I think there are some things to be considered there, but I think getting those folks into a banked economy and giving them access to the same ability transactions is something that is ultimately a good thing. And so that's the idea, and yeah, I look forward to hearing your.
Great. Well, thanks, Manoj. Well, it's interesting. We've heard about how the gig economy creates problems of inequality, and your paper tells us about how it actually may also help us solve those. So thank you. So our last paper from Joe, Ramsey described this to me as think about the Nile as simultaneously constituting Facebook and Amazon. So Joe, the floor is yours.
Thanks very much. Thank you to Ramsey for inviting me to this conference, and I'll be brief because there's a lot to discuss already, and time is running. And I have some slides, and in discussion, I'm happy to show a few things via Ramsey if need be. But to keep it simple, I'll just sort of try to summarize what was kind of some thoughts, not really even a working paper, but just some thoughts on these ideas. What is an ancient historian doing among lawyers? I mean, it'd be a really good question. Ancient legal regimes, ancient economies, how do they relate to modern policies at all would be a really good question. I think the link would be around notions well developed within political economies. And after all, this goes back well more than a century. The foundations of modern historical social sciences, including economics, comes from originally looking at ancient fiscal policies and taxation regimes in comparison, and so on. There's been a lot of work recently on fiscal sociology and taxation in pre-modern states. There's actually a huge amount of literature, believe it or not, in the last decade, building on Kaiser and Levy's work on fiscal regimes, but a lot of other things as well. The literature tends to be Eurocentric and presentist, of course, and it tends to stress linear developments, rather like what we used to call anyway, Whig history. But pre-modern systems, Egypt included, but pre-modern world in general, shows a lot of non-linear development and generally mixed systems, and the mix, whatever percentage between bureaucratic and patrimonial systems combined. And I think that's rather an important observation. Now, Egypt, of course, going all the way back to Marx and Weber, and many others, Karl Wittfogel, of course, has always looked at Egypt and the Nile environment as producing a highly centralized despotic system, despotic including extremely high taxation regime, because there was no resistance at the local level to the ruler at any period. And the Nile, in fact, is actually really important in the story and serves as a contrast to almost everywhere else on the planet. It is, as I've suggested in an earlier piece, the best place on Earth for taxation. Just purely looking at a satellite map that I could show you to remind you, it is actually the best environment anywhere in the world historically if you're a ruler who wants to tax. But I think there's a lot of complications around the nature of taxation, the bureaucratic system, the tensions between the aims of the ruler and the institutions around the collection of taxes, and local communities who are actually controlling the agricultural production, controlling the irrigation systems, and actually have most of the information that the ruler doesn't have, absent a decent reporting bureaucracy, which is actually fairly problematic. This is a very dynamic system, which we now know quite a lot more about, and something I've been working on now in terms of the variability of the annual flood, which of course is famous. How much variability and what's driving the variability has been understood in the past on centennial timescales, more or less, and we can now, thanks to climate science and climate modeling, examine variability on an annual basis, even in antiquity, which is pretty spectacular. So we can understand the variability and quantify it to some extent annually, which is interesting by itself as a problem in terms of fiscal regimes and the nature of state power. Yes, there's a lot of agency problems, I think, in the system that we can talk about, and there's a lot of discussion about agency and about the local power structures. In the case of Egypt, we're talking about Egyptian temples and priesthoods, with most of the information in the place where writing happens and recording of things like property rights, but also in terms of legitimizing the ruler. So it's not just despotic in the sense of a monarchy, one-man rule, and nothing else. Actually, it's a very complicated political system, which I think is rather interesting. And yes, there's quite a lot of resistance. Weapons of the weak, to use James Scott's famous phrase, which we can now understand also annually, connected to flow of the river. So there is a lot of resistance, revolts, sometimes quite serious revolts. In the case of Egypt, for example, we know of one revolt that lasts 20 years throughout Egypt, and because this is a period when there are tax receipts issued by banks, for the first time, I think, in world history, we can actually track the connection, and there isn't a single tax receipt in this 20-year revolt period, which I think is pretty dramatic illustration of the connection between flooding problems and the collection of taxation. There's no time to discuss the legal system and property rights, but I think that's also, we know quite a lot about both, and they're rather important, even in a place like Egypt. All of this to suggest that the cartoon version of Oriental despotism, of highly centralized political power in an environment like Egypt, should be considerably nuanced. In general, I would say that Egypt is a case, to use Daron Ajamaglu's categories, of relatively high tax regime, but also a high public goods provider, which I think also is an important observation. I think I will simply stop there, and I'm looking really much forward to the conversation the next 45 minutes or so.
Great, thanks so much, Joe. That was really interesting. So what we're gonna do now is transition into our discussion time, and we'd like this to be interactive. I have a few questions in the chat here. I have some questions myself for the panelists, but I'd like to intersperse those with questions from the floor. So if you'd like to ask a question, function, and I'll try to intersperse your questions with our conversation as well. So before I get into some questions that I had, I wanted to ask whether the panelists wanted to react at all to each other's papers. So if anyone would like to do that, please just go ahead.
I have a question for Reuven. So should
yeah, please go.
I'll do it. So I love this idea. I was wondering how much you imagined tailoring the progressive rate depending upon kind of the variable badness of bigness in different industries. I imagine you've thought through this. So I'm curious for your thoughts.
Yeah, no, this is exactly what I think is the wonderful thing about the corporate tax as a regulatory mechanism that you can, I mean, we've been doing this forever. In fact, in my opinion, that's what we've always had the corporate tax for. And, you know, we've been giving all kinds of, I mean, we have not, before 2017, we had a nominally high corporate rate, but very few corporations actually paid it. You can argue about whether we should have been giving, you know, incentives to fossil fuel industries, but we've been using investment tax credits. We've been trying to incentivize corporations. Corporations are very important players in the economy. So we've been trying to use them, the corporate tax, to incentivize them to do various things. In the current context, I think that's exactly right. I mean, some of the top, you know, candidates in my list are, for example, big pharma. Pfizer is one. I certainly would not want to disincentivize them from inventing the COVID-19 vaccine. So I would give them incentives for that. I would try to reward good behavior, but also I would try, I mean, in the case of the big tech, I think a lot of it is bad behavior. And so I would try to disincentivize that. That's exactly what I like about using the corporate tax in this way.
So for you, Ruben. And so, I mean, you set this 8% super marginal, super high rate for $10 billion and above. And so, to the extent that that's an attempt to get the supernormal returns, is that just an administrative concession? Because, I mean, I can see low margin, high profit businesses that might have $10 billion or more, but it wouldn't be super normal. And so if it was possible just to do it on an ROI basis, would that administrative, I mean, I know there's administrative problems with that, but because I can imagine there being lower profit operations that have super normal returns, but just below 10 billion. Sorry, you're muted, Ruben.
Yeah, Ruben, you're muted.
Yeah, that's a good point. I think it, ideally, of course, I would have loved to find a more direct proxy for rents. I'm not sure how to do that exactly. I do think that in general, the higher the profit margin is, the more likely it is to be monopolistic. This is this great paper that Ed Fox, Zach's co-author, did a while ago, that he took the actual corporate tax returns between 1995 and 2013, and he said, what would happen if we allowed all corporations to expense all of their tangible investment, as we also already do for the R&D, their intangible investments. And what he found was that almost nothing has changed. So in general, the empirical findings have been that most of the corporate tax falls on rents, and not a lot falls on. So the corporations that have a lot of competitions are unlikely to have very high profit margins. But you're right, it's a rough approximation. And if you can suggest something that is more directly tailored, like I love your proposal of directly tailor the consumption tax rate to the individual circumstances of the consumer. And if we could find something like that, that would be great, but I don't think it exists.
So if I could intervene here, I want to sort of react at Ruben's proposal, but also I think in things implicit in Zach and Manoj's proposal or ideas from an antitrust perspective. And so I'm thinking here about a quote I read some years ago in Ron Chernows' The House of Morgan by a senior executive for the House of Morgan during the early 20th century. And he said, what I really wish is that they, meaning all these regulators that want to regulate investment banking, would just tell us how much profit we're allowed and then leave us alone. And I think what is problematic about that idea, right, which is what regulatory policy will do is tell you how much you can have as a profit. In terms of the underlying problem of power, which is the problem that we're concerned with respect to monopoly at least, is a problem that Learned Hand identified in a famous opinion called Alcoa in 1945, in which he makes the point that when Alcoa says, like, well, we're not earning a big profit, so don't consider us to be a monopolist. Learned Hands, here, I'll read the quote. His answer is, many people believe that the possession of unchallenged economic power deadens initiative, discourages thrift, and depresses energy, that immunity from competition is a narcotic, and rivalry is a stimulant to industrial progress, and that the spur of constant stress is necessary to counteract an inevitable disposition to let well enough alone. Or as the Nobel laureate John Hicks once said, the best of all monopoly profits is a quiet life. And so what I wonder about is, to the extent we're using the tax system in any way to get at problems of corporate power or economic concentration of power, is thinking about the profitability of the enterprise even addressing the real problem. We could create a system where we're eliminating the ability to profit from monopoly from externally or accounting monopoly profits, and yet then we just sort of get the internal consumption in various ways of the monopoly rents by the managers of the firm. So I guess this for all the tax people or anyone else who want to get in on this, that's sort of a question about whether the problem that the tax folks are seeing is the same problem that, say, the antitrust folks are seeing.
The same problem, and I would be the last person to say that tax is the only way of getting at it. I was just suggesting it as a complementary way. I mean, I think the fundamental problem, at least historically, is that, you know, from my perspective, antitrust has not been doing a great job about this because, as you know, most of the big cases in the last, you know, several decades, like the ones against IBM and Microsoft and so on, were not successful. We'll see what happens now with the Google and Facebook cases, but I'm all in favor of more antitrust enforcement. We used to have more of that. Maybe we'll have more of that in the future. But this is kind of a complementary idea, what I'm suggesting, not a sub.
Others want to weigh in? Zach, I think you're on mute.
Oh, so a couple of thoughts. So you know, taxing shareholders would help some. You know, the higher the taxes on the returns from big corporations, the less would be an incentive to make all those profits. But you know, that's not very tailored to the particular concerns of antitrust. I think that, and this is in part in response to Manoj's exchange with Reuven, I think that this is in part a reason to have a corporate tax rate and a high corporate tax rate and a corporate tax rate that targets rents. So this is something that Reuven and Manoj were alluding to, but you know, under like reasonable beliefs about the world, our corporate tax now, today, targets rents. Like, we've done it. And we've done it through basically allowing companies to immediately deduct all investments, which for reasons that get kind of wonky, basically means that you're targeting rents. So I view that as a good thing. We're targeting rents that, when you target rents, you don't distort economic activity, and you're also in principle discouraging anti-competitive behavior because you are making it less advantageous to, you know, to get those rents. So I guess that I would say that to the extent that this is a concern, this is a reason to kind of, in some sense, stick with the base that we have been of the corporate tax that we've developed over the last couple of decades, and raise the rates, progressive or not, but raise the corporate tax rate.
All right, so I see some questions from the queue that seem related to this conversation. So let me bring in Faisal Chaudhry's question a while ago in the chat. He asked for Zachary, but I guess really for anyone. In Branko Milanovich's new book, Capitalism Alone, he notes, in a sense doing Piketty one better, that one of the striking features of today's inequality is historically distributed not just by the role of untaxed capital income, but by a top that is rich in virtue of both enormous labor and capital incomes, e.g. US 1/3 of top 10% of income earners are in the top 10% of both labor and capital income compared to 1970s. And then the question was, how does this affect class basis for thinking about who comprises the public for purposes of assessing public feeling or for or against shifts in taxation policy? So Zach, why don't we start with you, but then we'll maybe ask Manoj and Reuven to weigh in as well.
Great. So I'll start with the survey specifically. So here we're trying to get a representative sample of the adult US population. Now, that's not representative of who's paying the tax. It's not representative of who has the political power necessarily, but it is representative of the US population, which has some relationship, decent relationship to how politicians act and how voters think. So at the same time, I think that the fact that wealth is increasingly concentrated is a very important fact here. We, in fact, mention it, or at least allude to it in our survey, in our video treatment. When I mentioned Mark Zuckerberg, that wasn't incidental. In the surveys, we literally talk about a loophole for Mark Zuckerberg and how this lets him get away with not paying tax. And this loophole overwhelmingly benefits rich people, which makes it all the more striking that, although when you just say that, it increases support for taxing Zuck today. When you also include like the reasons why you might not want to have this, it doesn't make a difference. So what we take from that is that, at least in this particular sense of taxing unrealized gains, which is a lot of capital, most capital, there's just this really strong intuition that's a real big problem, and it's more and more of a problem as wealth gets more and more concentrated. So it's all the more important to, I guess in my opinion, to look for ways to reduce the concentration through taxing capital in the ways that are available to us.
Manoj or Ruben, did you want to weigh in on that question?
Interesting is who determines the terms of the conversation as it is. That is, I think this realization question is a little technical for most of the public. I'm not sure if there was a debate about this in Washington that many people will pay attention. I mean, the example now is that this particular proposal for taxing billionaires is on the legislative agenda in New York, California, and Illinois. And I don't get the sense that this is a massive subject of discussion, even in their states. The people who are paying attention are the billionaires, and they are doing a massive lobbying activity against it. And that's what you would expect if this were to happen in Washington, D.C.
Go ahead, Manoj, yeah.
Yeah, I was going to say, well, and Zach alluded to this when he gave his talk, if Zuck 2015 bought $114 million worth of property, there are ways to get at some of these what the public feels should be taxable events through a consumption tax if it's applied in an administratively feasible way.
So I wanted to read a question that Ramsey had for Ruben, which was, as a theoretical matter, just how good is the corporate tax at reaching rents? Approximately what share of actual rents?
I mean, I think there are two sides of this question. I mean, one side is how much of the corporate tax falls on rents. And here, I would refer to what Zach said a moment ago, which we think most of it, especially under current conditions. But I guess Ramsey is asking what percentage of rents is taken by the corporate tax, and the current corporate tax rate is quite low, 21%. It's the lowest it's been, I think, in American history. So the answer to that would be low, and my suggestion is that it should be higher, and I think Zach agrees with that as well.
Okay, so I wanted to, we have some lots of good tax questions still to go, but I wanted to sort of ask a question that maybe relates Zach's paper to John's paper, and it has to do with tangibility and intangibility. So Zach's paper suggests that people tend to think about unrealized stock gains as sort of paper gains, almost like they're not real. They're sort of ephemeral. Money, they're just kind of things that they don't really make people richer necessarily. It's just paper money. And John then tells us that both individuals but also regulators have thought about attention as sort of also kind of too intangible, too not real to take into account in making regulatory decisions. And so I wonder whether one of the problems of the digital age, and in particular in this question that Ramsey has framed for us in this conference about how we think about distributing the gains from the digital age, is that both individual citizens, but also regulators are too tied to the concrete, to the tactile, to the tangible, and lack the imagination or the realization to see power and wealth where it's most intangible. And if that's true, then what do we do about that? So maybe, John, I'll address that to you first, and then get Zach to weigh in, and then ask our panel generally.
Sure. A wonderful question, Dan. Very, very generative. I would say that some of that work is being done for us. This is not a silver lining of the coronavirus pandemic, but it is an effect of the coronavirus pandemic. I think we are all, as a society, realizing that increasingly life occurs via these intangible media, right? And I think that will naturally redirect attention onto the kinds of things we've been talking about today. So I think, you know, some of that is just going to happen to us. I think some of the problem today is also related to an overemphasis on privacy. I don't think people respond in a particularly tangible, noticeable way to privacy changes, right? Whereas the reason I focus on attention more is that I think we actually do respond to changes in advertising load and pulls on our attention. So it is a little more tangible in that sense than the pure abstract notion of privacy.
Zach, you want to weigh in?
Yeah, I love this idea. And so I think that the idea that there are certain things that's harder for the public to kind of get a grasp of is a real one, and that tangibility probably has a lot to do with that. I love the word. I had not kind of thought of that in this context, but yeah, there is a sense in which paper gains they're not tangible. They're not real, and you know, as Reuven was alluding to, there's always a question of how much public views matter for policymaking. Certainly, there's a heck of a lot of evidence that that they do matter in many cases, though not necessarily in all cases. We will see how these things play out. I guess for things in which the public is paying attention, which tends to be things like taxation. Like, the public cares a lot about taxation. It's not, this is how I introduce my tax to my students every year. Tax isn't some like thing that people aren't paying attention to. This is like really central to their lives. It's how we constitute our society, and to a large extent, and you know, it's important to their individual behavior, their pocketbook. So when there are things in it that they don't get, that can be a big problem. And I like that. I like the framing of it about tangibility. Yeah, great.
And Manoj, interestingly, you know, consumption seems tangible in a way, right? It's what people are eating and what they're drinking, what they're buying. So maybe your idea actually has more possibility of generating sort of public acceptance because it seems more tangible. What do you think?
Yeah, I think so. And again, consumption as a base for a while now, and I do think some of the compelling points are in its favor are, well, if you just have money sitting in your safe, then why are you better off than somebody that doesn't have that money for not spending it? I think there's arguments on either side that, well, you've got some security, you've got people know you're wealthy, they might give you more stuff, but I think that going back to the term that was just used, is tangibility or concretizing your money, actually using it. In an income tax, we've got the realization requirement. Just gain until you actually sell the asset. Now it's tangible, and I guess consumption is taking it one step further. It's not really tangible until you actually use it up in some way. And so I think the public, again, to the extent that we care about what the public thinks, I think that there's generally, what studies I've seen, broader acceptance of tax and consumption, in part because there's also a voluntary component to it. And so unlike income, which is once you get a job, even if that job is somewhat lucrative, you can't really regulate the amount of income you have by working half the year for most folks that are salaried. And in contrast, a lot of consumption is discretionary, and so to the extent that you don't like the tax that's being levied on consumption, you have the ability to not pay it. I think the public finds that generally compelling. And still an open question, to what extent do we defer to the public on what they think about tax in creating our tax rules? But it's not nothing, obviously, because the political economy question backs possible.
So I have a couple of questions now here in the queue for Joe. I'll put two of them together. So Ramsey asks, is it denial and its massive network effects that accounts for the centralized nature of power in ancient Egypt? And then Faisal had asked, do you have thoughts about how the empirical evidence about ancient taxation does or does not speak to questions about origins and nature of money, chartalism versus commodity theories, et cetera, Graeber, Desson, et cetera? So I will pass those on to you.
Great. Thanks. Those are thoughtful and intense questions. The one by Ramsey is easier to answer, I think, in terms of the connection between centralized power and the irrigation system. This is the classic political economy theory about irrigated landscapes and despotisms in China, India, the Near East, and Egypt, of course. And there's no direct connection between irrigated landscapes and highly centralized political power. The connection is when there's stored caloric potential. That is, when you can get surplus grain storable, that does lead to bureaucracy and political centralization. I think that's important. And you see another Ramsey question too about political breakdown. And that's what I think happens in these phases of localized control that we see about 5 times in ancient Egyptian history, where the central state goes away and you have large local communities essentially running the show. These are associated always with long-term Nile flood discontinuity, where you have really bad flooding for a century or more, not just for a year or two, which destabilizes the system we know already. But when you have long-term floodplain contraction, which we can now track pretty well, that's when you get the central state basically disappearing, and you get larger, or let's say regional sorts of states. In terms of origin of money, gosh, I mean, that's a big question. Thanks for that. Of course, Egypt has a concept of money that goes very far back. It is commodity money. It is generally grain and metal, weighed metal, that's used in exchange in essentially a barter system. The Ptolemies, after 300 BC, introduced coinage for the first time, and banking and tax farming in a much more complicated system to try to control production and to redistribute it. And it's we can argue how successful it was, but the grain tax is the main thing that stays, and it's a share tax, not a tax in coinage, unlike vineyards and the capitation tax and so on, which were in coin. So there are differences in how tax was collected. It gets very complicated later on when we have banks and we actually have coinage circulating for the first time in Egypt. So yeah, I do have thoughts about Graeber and Desson and others, but I'll leave it there for now. Thank you.
So Joe, you're talking about storing up grain as a sort of a source of power. I was thinking about the biblical story of Joseph and the grain, yeah. Right? This is very much in that sense. Great, thank you for that. There's a question now from Shubha Ghosh. Shubha is an expert in both IP and antitrust, now for the tax people. And Shubha asks, what are the panel's thoughts about a federal tax on patents and trademarks? In other words, a tailored intellectual property tax. Perhaps the panel has no thoughts on a tailored intellectual property tax.
We encourage intellectual property a lot. I mean, that was kind of my point about R&D, which is what produces intellectual property. I mean, we allow the current deduction of R&D, whether it's successful or not. I mean, if it's unsuccessful, it's okay to deduct it, but if it's successful, then it produces an income stream that lasts at least for the length of a patent, in the case of a patented product. In the case of a copyrighted product, it can last for 100 years under current copyright law because of Disney. So essentially, the income stream is for a long time. And the normal tax rule is that you match the deduction to the income stream. So you're supposed to deduct it over time as the income comes in. But we don't do that. We allow for the current deduction of it. And the argument is that it produces positive externalities because the people who work on it can go to another firm and that you get to Silicon Valley. But I'm not sure that's true anymore, because the reality is that the giants pay so much that they attract all the talent, and I'm not sure that too many new startups set up around them. So I actually think that we should be changing the rules to subsidize R&D a little bit less. Whether we should be taxing IP directly, I mean, the income from IP is the income that I'm essentially trying to tax. So that's what the corporate tax that I'm proposing does.
I would say too, just briefly adding on to that, I think essentially a tax on advertising does what Reuven just said too, right? It's a kind of indirect way to get at the negative aspects of trademark value, I think, right? And this actually would tie a little bit into some of Ramsey's work as well on advertising and monopoly.
It seems like any tax would have to be tailored to the IP that we're talking about. And so to the extent that we've got some positive or negative externalities for a given category of IP, then you could adjust it accordingly. But there's plenty out there IP-wise that I think, you know, an author with a copyright on a book, that, you know, that just seems like a neutral thing. It would involve some kind of empirical work in the different categories of intellectual property, probably.
Okay, well, I will continue down the queue of questions here. So Ramsey asks Zach, what are the implications of your survey for the view that we need to use antitrust to break up concentrations of economic power?
Not much. I think that this is saying that one implication is that it'll be harder. It's harder to tax capital. It's going to be harder to tax those returns. So it'll be a little harder to use taxes to break up concentrated capital, because a lot of those returns come from that concentrated capital, or the concentrated power. But I think a different and interesting survey that someone should do is understand what people think about antitrust. My hunch is that people don't like corporations much. They really like the corporate tax. My hunch is that they don't like big corporations either. Though I don't know. That'd be a great area to explore using similar methods.
You know, Zach, your comment reminds me of a survey I saw some years ago about lawyers, which is everyone hates lawyers, except they love their own lawyer. And this goes to, like, everyone hates corporations in the abstract, but man, I get a lot of value out of Facebook, or I get a lot of value out of Google or Amazon, right? And so I think there's, you know, we have to be careful as how we ask generic questions and then translate that into actual willingness to support your policy proposal. So let's see, there was another question for you, Zach, I think from John. John, do you actually just want to ask your question directly instead of me reading it?
Sure. So my question, unsurprisingly, has to do with attention, since I've been thinking about it a lot. But if one were inclined to argue in favor of the realization rule, you know, might an additional argument, aside from just administrability concerns, have to do with the saving of attention that is allowed when you don't have to try to assess value, either as a taxpayer or as a tax collector, every single year?
Yeah, so there are two questions that are embedded there. One is, what do people out there in the world think, and another is, what do we as analysts think about that relative to the costs and benefits? So on the first, what do people think? They talk about it being complicated. So they do. So that definitely is, like, we ask them, they write free form, like, why do you not like us? And then they give that reason. So the second question, though, is like, what do we think about that? And it's hard for, the surveys just to understand what people think. As to whether we think that could possibly rationally drive people, it's hard to see that, because people they're already paying tax every year. You just get a statement from Charles Schwab that says how much your stocks went up in value, and then you pay tax on that. So it's one extra line to fill out in the tax form. So it's the kind of thing that might seem kind of big and scary, but at least with respect to liquid stocks in your Charles Schwab account, it wouldn't be. But people are definitely concerned about it. So you're absolutely right. I agree.
So we have a couple more questions for Joe, which he's graciously offered to answer offline, but I really want to hear the answers myself, so I'm going to pose them. So Ramsey asked, were there historical periods during which control of the Nile was broken up or divided within the Egyptian community? And if so, what accounts for the tendency of centralized control over the entire Nile to reassert itself? And then John asked, how were taxes collected? Fiat currency, grain, both, something else? A neoclassical microeconomist would say that the medium shouldn't matter, only the value, but springboarding off of Zach's work, might the median matter psychologically? Wow. All right.
Yeah.
Joe, go to it.
Yeah, wow. These are books I should be writing. Thank you. Fantastic. Yeah, as I suggested, there are periods. Egyptian history has these dynastic cycles in some ways similar to Chinese history. So there's centralization and decentralization 5 times in the 3,000 years of dynastic Egyptian history. They seem to be related to severe climate change, to summarize. That is what's called Nile floodplain contraction. Just much less water flowing through the Nile River Valley leads to breakdown of authority of the ruling family, basically. Why does it reassert itself? I mean, that tends to be Egyptian culture is so much related to the pharaoh, the legitimate king, the lawgiver, etc. And the dynasties get reasserted, but not automatically. I think there's probably a tremendous amount of not only politics but coercion that we tend not to have in the historical sources, but they're probably there when you re-centralize the state. Interestingly, when the states re-centralize, they're very different sorts of states. So Egyptian history in ancient periods is not all the same sort of thing. The Middle Kingdom after 2000 BC, radically different than the Old Kingdom, age of the pyramids. The New Kingdom, radically different in the middle of the second millennium BC than the Middle Kingdom, and so on. So there's tremendous historical change on how Egypt is actually working, but the concept of a central king with the bat phone to the gods, that sort of idea, as kind of the coordinating mechanism. And that's what kingship is. It's a coordinating mechanism between the central corporate idea of the state and the local communities, with expressed in temples and cults in local areas. And so that's very interesting. There's a huge ceremonial component to how kingship works. The second question was how taxes are collected. So great, and it changes a lot again, but in general, after 300 BC, this period I work on, it's very interesting. The main tax is the harvest tax, collected as a share of the harvest, and you can imagine the problems of share taxes. It's a good reason when Rome comes into Egypt, they get rid of the share tax and impose a flat tax on the land and get rid of the share tax. Share taxes obviously present lots of problems, but that's the ancient system which these Ptolemaic kings, these Greek kings after 300, just continued from the pharaohs. There are money taxes which are guaranteed by tax farmers through bidding and through auctions that we know quite a lot about after 300 BC, which is interesting. The head tax, the tax on vineyards, for example, are taxes calculated and collected generally in coin. So it's a pretty complicated system after 300 BC. And I think there are psychological differences. I do think the medium does matter in the ancient context, at least in Egypt. So thanks for that. And that's something that's worth exploring more. I'll leave it there.
All right, well, thanks. I think we have left for one final question. I apologize to those in the queue still who I couldn't get to all your questions. And the question from Isay Yassar was, even if big tax was taxed, what would the exact use of that for the people in the U.S., keeping in mind that the welfare state is very limited? Would it be just an attempt to curb economic and political power as such? I have connection. Sorry. So the last part was just a disclaimer about connection problems. So the question is really, is the goal of raising more taxes really in some sense Pigouvian, as John said, which is to control a problem, or are we simultaneously trying to solve a revenue raising problem, and if so, for what purpose? For what expenditure purpose?
So my view is that we don't need the corporate tax for revenues. It collected about $230 billion last year. That's less than 7% of total federal revenues. If we just need the revenue, we can have the income tax. We can have a consumption tax on top of the income tax, like Manoj was mentioning, and we can easily collect the revenue that way. So if it was just a revenue issue, we wouldn't need the corporate tax at all, and we could just get rid of it.
I'd say my sense is that it might or will differ depending on what government institution we're talking about. If it's a state level question, revenue collection is a real concern, and especially if there's a ton of activity that's shifting to a right now untaxed medium, right? So from the state level, yeah. But as a millennial, I am of course a big believer in the money printer go burr theory of federal taxation and spending. So it seems less salient there.
I guess I totally agree with the thrust of the question. A huge problem with the rise of big tech is not just the market distortions, but also the fact that so much of the wealth has gone untaxed, either via the corporate tax or the individual tax. And that's a huge issue for issues of inequality. And then also an issue for, star of the state kind of issues that will eventually have a bite on what we can actually do with government spending to benefit, especially the lower income folks.
So Zach, as I was listening to your presentation, I kept thinking, I wonder if there were people in your survey who were thinking the problem with collecting for unrealized stock gains is that it'd be successful, that it'd give and you sort of hear these kind of lines, in popular culture, which is, we don't want the government collecting more money, because when the government collects more money, the government gets bigger and more powerful. And that's another kind of monopoly, another kind of big thing in our lives that we also fear. So I think part of what we're discussing here today is just how we simultaneously solve for the concerns around excessive power and inequality in the private sector, in individual hands, but also the same concern that someone like Louis Brandeis was concerned about, right? Brandeis both wanting to check corporate power, but also wanting to check the governmental power and striking down the New Deal in the Supreme Court. So, well, with that, I think our time is up. So I will say thanks very much to our panelists. That was really great, and to all the audience questions. I really appreciated that and enjoyed it. And I will now turn it back over to Ramsey.
Thanks very much, Dan. Thanks for the great moderation, and thank you to our panelists for a fantastic and varied discussion.